Have you ever wondered what keeps the economy humming along? What prevents complete financial chaos or runaway inflation? A big part of the answer lies with something called a central bank. And in the United States, that central bank is the Federal Reserve, often just called the Fed. So what is a central bank? Simply put, it's a public or public-private institution responsible for overseeing a nation's monetary system. Think of it as the bank for banks. It's not where you or I go to deposit our paychecks or get a loan. Instead, it provides services to commercial banks like Bank of America, Chase, Wells Fargo, and manages the overall money supply and credit conditions in the economy. Now, why is a central bank relevant to you? Well, its actions directly impact things you deal with every day, like interest rates on loans, the availability of credit, and even the price of goods and services. Let's break that down. Imagine a world without a central bank. Banks would be free to lend as much or as little money as they want, potentially leading to unstable credit bubbles. If lots of banks lend too much, it could cause rampant inflation, prices going up quickly because there's too much money chasing too few goods. Or if banks become too cautious, lending could dry up, leading to a recession. A central bank steps in to manage these risks. Let's focus on the Federal Reserve. It was created in 1913 to address the financial panics that plagued the U.S. in the late 19th and early 20th centuries. Before the Fed, the U.S. banking system was incredibly fragile. Bank runs, where lots of people simultaneously try to withdraw their money, were common, often leading to bank failures. The Fed was designed to provide stability and prevent these crises. How does the Federal Reserve actually work? It has several key tools at its disposal. The most well-known is probably setting the federal funds rate. This is the target rate that banks charge each other for overnight lending of reserves. It doesn't directly affect the rates you pay on your credit cards or mortgage, but it heavily influences them. Think of it like this. If the Fed lowers the federal funds rate, it becomes cheaper for banks to borrow money. They then pass those lower costs on to consumers and businesses in the form of lower interest rates on loans. This encourages borrowing and spending, stimulating economic growth. Conversely, if the Fed raises the federal funds rate, it becomes more expensive for banks to borrow. This leads to higher interest rates for consumers and businesses, discouraging borrowing and slowing down the economy. This is often done to combat inflation. Let's say you want to buy a new car. If interest rates are low, the auto loan will be cheaper, making the car more affordable. More people are likely to buy cars, boosting demand and helping the auto industry. But if interest rates are high, the loan will be more expensive, and fewer people will buy cars. Another tool the Fed uses is something called the reserve requirement. This is the percentage of deposits that banks are required to keep on hand, rather than lend out. If the Fed lowers the reserve requirement, banks have more money available to lend, increasing the money supply. If the Fed raises the reserve requirement, banks have less money to lend, decreasing the money supply. Then there's open market operations. This is when the Fed buys or sells government securities like treasury bonds to influence the money supply. When the Fed buys bonds, it injects money into the economy. When it sells bonds, it withdraws money from the economy. Let's imagine a simple example. The economy is slowing down. The Fed wants to encourage growth. It decides to buy government bonds from banks. The Fed pays for these bonds with newly created money, effectively giving the banks more cash. The banks then lend this money out to businesses and consumers, boosting economic activity. The Fed also plays a role in regulating banks, ensuring they are financially stable and operating responsibly. This helps to prevent bank failures and protect depositors. It's a complex job, balancing the need to promote economic growth with the need to control inflation and maintain financial stability. Now, it's important to understand the Fed isn't just reacting to current economic conditions. It also tries to forecast future conditions and adjust its policies accordingly. This is incredibly challenging, as the economy is influenced by countless factors, many of which are unpredictable. To summarize, a central bank like the Federal Reserve is the institution responsible for managing a nation's monetary system. It does this by controlling the money supply, setting interest rates, regulating banks, and forecasting economic conditions. Its actions have a profound impact on the economy and, ultimately, on your financial well-being. It's a vital component of a stable and prosperous economy. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.